Hello, everyone. Welcome to another episode of the SQM Research Podcast. Today's a bit of a special one. It's a little bit like our grand final here at SQM. We are releasing our boom and bust report for 2026, which is always a big time of year for us. For those of you who are looking to purchase our boom and bust report, it is on the website for $69.95. Please have a look at it. We'll be discussing it today, what our predictions were for last year, what we got right, what we got wrong, and our predictions for next year as well. So please come online and have a look at that. But over to you, Louis. Let's discuss our boom and bust report for this year.
Yeah, so very quickly, Sam, finishing that point off, this year we've added some additional research. So we've added in a section covering the Sunshine Coast as well as Mackay and the Whitsunday areas. Why we've done that is that we think these are investor hotspots over the medium to long term, and there is more and more interest in these areas, hence the reason why we've expanded our coverage. And then over and above that, of course, we've done our usual postcode ratings and postcode stats for every postcode in the country. So if you like the research, please support us, buy the report, you'll get a lot of value out of it.
So let's start with, Louis, what happened in 2025. Now, you may have seen in our newsletter, we have a number of scenarios that we post every year. Scenario 3 was the one that we decided to go with as what we thought were going to be the concrete results that you may have seen. So, Louis, should we kick it off and?
Well, let's talk about that, Sam. So, at the beginning of the year, so when we released the report this time last year, our base case scenario was that we wouldn't see interest rate cuts until mid-2025. As we all know now, we had rate cuts starting in February, and that was covered under our scenario 3. So as the year started off, we essentially got down to one scenario, which was scenario 3, not our base case. So one of the reasons why we're not giving ourselves full marks this year, because we didn't pick scenario 3 as our base case. But nevertheless, since it happened really early onwards, we were able to tell all our clients and our newsletter subscribers, hey guys, we're on scenario 3. And what that meant was that we're forecasting a more bullish housing market than what we initially did. So our forecast for scenario 3 was that housing prices across the country would rise somewhere between 6 and 10%. And sure enough, the number looks like it's going to finish up about 7%. But there's been some pretty big variations in the market. Some cities that we didn't get right at all. And we should go through that and talk about that and why we didn't get it right. And in some other cities, which looks like we nailed it pretty well.
Well, I saw particularly Darwin was a huge swing from what I saw. There was a massive increase. I think it was 17% on there.
Yeah, that's exactly right. Darwin housing prices up 17% for 2025. Our forecast was relatively bullish, but not that bullish. It was for a forecast of 6 to 10%. Now, why Darwin's done a lot better than expected is that there's been a number of projects which have now completed in terms of gas projects. The economy's doing better than expected, what we thought it would be doing better expected. And so there's been more demand for housing in Darwin this year. And we think the momentum we're seeing in Darwin's going to continue on into 2026. But yeah, that's one example where we seriously undercooked the forecast. It's just been very, very strong returns. The other one, which we got wrong as well, was the Gold Coast. So our forecast for this year was that housing prices would rise between 5 to 9%. The final number for the Gold Coast looks like it's going to be 18%, one of the strongest numbers we've ever recorded for the Gold Coast. Now, we have concerns for the Gold Coast going forward, which we can talk about later. That market is seriously cooking along.
Well, I remember, and for those of you that have seen our podcast, on an earlier video, we talked about the Gold Coast being a bit of a transitory area where you see a lot of people kind of come and go.
Yeah.
As far as the Gold Coast is concerned, where you have people sort of live there temporarily, or they move overseas, or because of the type of area it is. What are sort of the reasons that we've seen such a drastic growth?
the Gold Coast historically has been a bit of a boom-bust town. But this time round, supply has been a bit lagging compared to previous cycles. And demand has still continued to run at pace. So the local population growth rate on the Gold Coast has been north of 2% per annum. So that's very strong underlying demand. Now, that all said, though, we're seeing situations where a lot of this underlying demand strength has now been priced into the market. Rents are higher on the Gold Coast than what they are in Sydney. Housing prices now are basically in the mid 1 million range for the Gold Coast. That's extraordinarily high for the demographic there to afford. So we're getting concerned that the Gold Coast has become quite overvalued. But we're not forecasting any type of crash for the Gold Coast next year. Indeed, we still think housing prices will rise, but we're just getting more and more concerned about the overvaluation that's occurring in that region.
And what are the sort of, obviously the population growth would drive that.
Yep.
But are there other factors that are driving that overvaluation?
Mainly supply. Like I said, supply's been lagging. But if you look at the number of cranes on the Gold Coast now, it's becoming obvious supply will catch up at some point. That may well happen in 2027. And I think that'll be the most concern will be for that year. There is a chance for price falls in 2027 for the Gold Coast, because I think we'll see that year, the year where supply will catch up to demand.
Yeah, interesting. So guys, one to keep a lookout for is the Gold Coast. If you have any sort of investments there or you were looking at that, that's something to keep in mind around that supply issue. We've also seen some other outperformances in Brisbane, Perth and Adelaide as well.
Yep.
Can we talk a little bit about that? Obviously,
yep.
We've heard a lot on the ground about Perth being kind of the new place to invest, with the East Coast being pretty full. There's quite a lot of attention driven towards Perth. Certainly my experiences, we've had a lot of clients inquiring about WA data.
Yep.
Any thoughts around that, Louis?
Yeah, look, we have seen outperformance in 2025 in the cities of Perth, Brisbane, we mentioned Darwin before, as well to a lesser extent Adelaide. I think they've risen for various reasons based on what's been happening locally. So in the state of Western Australia, we must remember a deal that happened a few years back between the WA government and the federal government on GST receipts. And WA managed to strike a very, very good deal indeed in terms of receiving a lion's share of GST receipts compared to the state's economic output. And what that has meant is that the state coffers in Western Australia have been running hot for some time now. And that's enabled the state to invest more in terms of public expenditure, more on roads and other infrastructure as well as amenities. And that has encouraged the local population to invest. Over and above that, mining receipts and royalties have been pretty good in the state of WA. Yes, iron ore prices have levelled out around $100 a tonne, not at booming levels, but still enough to create profits in the state. And then over and above that, gold prices, of course, have been running hot, and that's helped the state. And so with that, we've seen an increase in population for the state of WA, and that increase in population has basically overrun the supply side. Hence the reason why we've been recording very low vacancy rates for some time now. Hence the reason in 2025, dwelling prices rose by about 12%. And for next year, the forecast is for another strong year. We think potentially stronger at 15 to 20%.
Let's talk a little bit about each of the scenarios. So within this, we have 4 scenarios for 2026. We have our scenario 1, which is our base case scenario, essentially a 25 to 50% so basis point cut from mid 2026. We've got with steady but sluggish economy and inflation between 2.5 to 2.7% as a yearly average. So that's scenario 1. Scenario 2, we say there's no rate cut until late 2026. inflation will be between 2.75 to 3.2 yearly, and we'll have a slower economy. Scenario 3 is essentially a global slowdown spillover. We're looking at a 0.75% to 1% rate cut throughout the year, and also an unemployment rise to 5.5%. And then finally, which is scenario 4, which is an economic rebound, essentially rate cuts throughout the year. So between 0.5 to 0.75. And then we'll also have a lower inflation of 1.9 to 2.1%, falling unemployment back to a low of 4%. So Louis, let's start with scenario 1, our base case. Tell us a little bit about kind of the strengths and weaknesses of our base case?
Yeah, sure. So I think in all this, let's give a bit of a background how we come up with these scenarios. So normally what I do is I think of 20 most likely scenarios that could happen in Australia and across the world, and I get it down to the top 4 in terms of what we think is most likely. And then we put our hat on with our base case. And for 2026, the base case is, yes, we will see rate cuts, but they won't happen until the second half of 2026. And over and above that, one of our key assumptions as well, which runs across all scenarios, is that the level of migration will continue to slow. So we're anticipating that the population expansion for next year will slow down to about 390,000 people. And with that, this will be the first year since 2019, we believe demand will more or less equal supply in terms of what we're expecting for the number of dwellings coming in and being completed across Australia. Now, for those who have followed this closely and following our forecast closely, you'll see that for scenario 1, and it's the case of all the scenarios, we believe Sydney and Melbourne's actually going to underperform a number of the other capital cities. And let me explain why that is. So firstly, for Sydney and Melbourne, these are the 2 cities which receive the lion's share of net overseas migration. And then what generally happens is you see interstate outflows from Sydney and Melbourne into the other states. So if we're forecasting a slowdown in the migration growth rate, which we are, we think that's going to impact upon Sydney and Melbourne the most. And so it's one of the reasons why we think those 2 cities are going to underperform. Now, that said, there are local issues with the Victorian economy. There are some issues with the New South Wales economy as well, but the main issue with the New South Wales and Sydney economy is the unaffordable housing market. Now, the first homeowners deposit scheme will help. The interest rate cuts we've already had this year will help, hence the reason why we're still forecasting price growth out of Sydney and Melbourne. But there are issues in terms of affordability in Sydney, and there are issues surrounding the health of the state economy in Melbourne, hence the reason why we've not been so bullish on these cities this year. Now, in terms of the other scenarios, yes, the risk is that we will see next year sticky inflation. And that's the reason why this is our second most likely scenario, that inflation stays elevated for longer and it stays the RBA's hand. Now, in that scenario, it would mean for a slower housing market, and hence the reason why our forecasts are for slower growth, but not price falls in our second scenario. The third scenario is basically assumes that the tariffs, the barriers that we've built up, particularly in the United States, will slow down the overall global economy. Under that scenario, it would be a scenario where you see a sustained stock market correction. And we've been in the middle of one right now, but it's so to date, it hasn't been that great, but it remains to be seen. And as a result of that major slowdown in the economy, this forces the Reserve Bank to cut interest rates more aggressively next year. Now, under that scenario, we're not really forecasting strong housing price growth. And the reason is because the Australian economy would be slowing down as well, faster than what the RBA would be forecasting. And that means that we would see a more aggressive rise in unemployment. And when you see that, that's generally not conducive to housing price rises. And then finally, the scenario which is more bullish, I'm not particularly bullish that it's going to outcome like this, and that is we get an economic rebound due to the rate cuts we've already had in 2025. Now, it made the top four, it made it just above a recessionary outlook, but I'm not particularly, as mentioned, confident that this scenario is going to play out, because what it would mean is that we become, the productivity rates in this country would start to increase again. And I'm just not really seeing it.
And why? And obviously there's been a lot of talk throughout the year about a potential recession. Why is it that it dropped out of your top four? Is it
because of the interest rate cuts that we've had, Sam?
Yeah.
So the RBA has been pretty responsive already to the slowing economy. And so we think there's enough stimulus in the economy combined with the budget, the federal budget deficit that's been run to keep the economy stable. So a recession, of course, is where you see 2 negative quarters of growth, you see skyrocketing unemployment. I think that is an unlikely outcome due to the rate cuts we've got and this present stimulus with the government that's been spending pretty strongly over the course of 25.
Is there a concern that some states' productivity could still potentially drive a recession? Or?
Maybe a local state recession, potentially. Victoria would be a key risk state for that.
Yeah, fantastic, Louis. Fantastic. Let's talk a little bit, and last but certainly not least, a little bit about rents and where we see that sort of moving forward. Where have we seen the greatest rental change over the year?
So the greatest rental change has been in, once again, the cities of Perth and Adelaide and actually Hobart this year. So we've seen high single-digit increases in rents for these localities compared to our largest capital cities, where rents have just really increased in line with inflation this year. And once again, that boils down to very strong population growth in the respective states and supply not meeting that demand. That's fundamentally why we're seeing stronger rents. For next year, we still think that the states of WA, Queensland, South Australia, as well as actually Tasmania, and to a lesser extent, Northern Territory, will record rents rising quicker than the inflation rate. But the days of 20% plus growth in rents like we had coming out of COVID, they've well and truly gone. They're behind. One of the key assumptions behind our rental forecasts for next year, and you'll note that we're forecasting Sydney and Melbourne just to run in line with inflation, is that we think this will be the first year where underlying demand is more or less in balance with underlying supply. So we're forecasting expansion of 390,000 people and about 180,000 dwellings being built. And so the number of occupiers per dwelling generally runs at 2.6. So you work those numbers into an equation, and that generally shows that we'll record, if we're right about these numbers, a small surplus in building stock for next year. Not enough to see a cratering in the rental market, but enough to perhaps stop the rents rising by more than the CPI in a number of localities. Over and above that, let's remember we've got the 5% deposit scheme.
Mm-hmm.
That's going to encourage a number of renters to turn themselves into first-home buyers. And so that should ease some of the pressure in the rental market that we've seen for the last few years. That's
all we have time for, Louis. Thank you so much for taking us through the report today. As mentioned at the start of the video, guys, if you're looking to purchase this report, please visit us at sqmresearch.com.au. The report will be for $69.95. And as Louis mentioned, we have a few other special areas in there that we think are great investment hotspots. So please check that out and see you next time.